Topic 10 would be the financial plan. At the end of this topic, students will be able to understand operating and capital budgets, explain pro forma income statement, prepare break-even analysis, explain pro forma cash flow statement, and explain pro forma balance sheet. Financial plan will help an entrepreneur to estimate the proposed sales, cash flows, and profits. It also helps him to identify his break-even point to prepare himself to achieve this position at the earliest. He also will have knowledge of the financial position of the business in regards to assets and liabilities. This plan will project the finances for a future period, and such estimation will make financial management effective. Finance is a crucial element for a business. Most of the firms close down more for its mismanagement than for the lack of finance. When financial resources are maintained as per plans, an entrepreneur can make good managerial decisions as to when to borrow, where the expenses are large, and why cash flows are tight. Let us understand operating and capital budgets. A budget is a prediction or forecasting of an event based on solid assumptions. These budgets, when applied to a business, will guide towards the organization's goal. A sales budget is first prepared to estimate the expected volume of sales, and then a pro forma income statement can be prepared. Capital budgets are intended to provide a basis for evaluating expenditures that will impact the business for more than 1 year. A capital budget may project expenditures for new equipment, vehicles, computers, or even a new facility. It may also include the computation of the cost of capital and the anticipated return on the investment using present value method. Pro forma income statement. It is nothing but the projected net profit calculated from projected revenues minus projected cost and expenses. The first step will be to project the sales, as that is the main source of income. Then projections for all operating expenses are made. The differences will give the net profit or the net loss. Care should be taken that the projections are just estimates for the future, and they should be based on solid assumptions, and the projections should be as close as possible to the actuals. If this is not done, large deviations from the pro forma with the actual will occur. It will result in an unrealistic budget. What is break-even analysis? It is the volume of sales where the venture neither makes a profit nor incurs a loss. The break-even sale point indicates to the entrepreneur the volume of sales needed to cover the total variable and fixed expenses. Sales in excess of the break-even point will result in a profit as long as the selling price remains above the costs necessary to produce each unit, that is the variable cost. The formula could be in the form of this, that is the break-even point in relation to the quantity could be equated to the total fixed cost in the numerator divided by selling price minus the variable cost per unit, that is the marginal contribution. Pro forma cash flow. It is the projected cash available calculated from projected cash accumulations minus projected cash disbursements. It is important for the entrepreneur to make cash projections as if disbursements are greater than receipts in any period of time, and the entrepreneur must either borrow funds or have cash in the bank account to cover the higher disbursements. Large positive cash flows are also to be streamlined profitably. Pro forma balance sheet. It summarizes the projected assets, liabilities, and net worth of the new venture. A balance sheet is a picture of a business at a certain moment in time and does not cover a period of time. Assets. It represents the items that are owned or available to be used in the venture operations. Liabilities. It represents money that is owed to the customers. Owner equity. It represents the amount owners have invested and or retained from the venture operations. So that would be the end of our topic 10, to prepare a financial plan, which is very much mandatory and a part of a business plan. And we will have to now move on to topic 11, the sources of capital. Thank you.